Hello and welcome to week number 8 of weekly preview. We'll be previewing this week and the following one as well, which will be the NFP week altogether in this video. Starting off by having a look at inflation expectations. So if you're on TradingView, it has got the function to check that out on a single chart, so you can overlay it with other currencies as well. It's got different tabs. One tab of them says economy. And if you type in inflation, there's a neat little chart here that says 10-year break-even inflation rate. Basically, that's the inflation, what market is discounting in due time, in 10 years out. There's a different chart for 5 years as well, but for today's purposes, we'll be using the 10-year one. We've been excessively discussing that at what levels these all peaked. For the 5-year one, it was around 3%. For the 10-year one, it looks like that is setting up to be a little bit lower. But either way, what it looks like is inflation expectation is started to peak and is starting to trend back down. If I were even to look at the monthly, you can see that it's fairly consistent with what we've seen the past 20 years or so. So it's fairly consistent, and market is not expecting this to pop. But what does that mean for the currency markets? If I were to compare this with any yen pair really, apart from USD JPY, because the reaction function is a little bit different. But if you look at CAD JPY, for instance, more or less, we can see that the extremes, CAD JPY reacted to the extremes, as well, I meant to say. Sometimes you see maybe one was leading the other, but generally speaking, when you see inflation is peaking, you can expect that yen pairs kind of nearer the peak as well. I can check that with another pair, say AD JPY, as it's quite popular to trade on risk on, risk off. So even this correlation taking all the way back to 2002, 2003, where probably majority of you weren't even trading back then nowadays. You can see more or less to some degree it showed where the peak was, specific turning points in the even to look at maybe the low here from 2008 crash, and then the 2009 and 10 we saw the annual peaks keep getting pinpointed really by this inflation expectation chart. So this to that, it's quite reliable in the long term. In the short term, sometimes you might see dislocations like we had here in 2018. Where inflation expectations kind of just were stagnant, but yen pairs already did the dive, and then inflation expectation kind of came down with it until the latest recession, and so on and so forth. Right now we're in a scenario where it's really difficult to imagine why inflation expectations should break higher unless there is something new coming into the market. But the whole idea is that inflation expectations are coming down the second part of this year. That also means for yen pairs there is not a lot to celebrate. I'll go down to the daily, you can see why. So we had inflation expectations coming off last week, and I'm expecting yen pairs to kind of reflect that as well. So a bit from the sort of bond and yield side of things. Now let's have a quick look at what the CFTC data is doing. This report is from Scotiabank, been published on Friday, but it's covering data up till Tuesday last week. Really what I'm interested in is what are Eurolongs doing here, because Eurolongs are quite relentless. Since November they started buying and building up long position. Now last week the long position, if you can see the details, that did not increase quite a lot. Actually it decreased a bit. But when you look at the numbers here, you can see it's steadily climbing. So we had 1 week, 1st of February, went back a bit, but apart from that, the last 3 weeks or so, it looks like it added about 2 billion, more than 2 billion contracts long. That is thanks to short covering from Euro side. So Euro shorts let go of some of the positioning, and that caused the long exposure on the Euro to rise quite dramatically. If I were to look at this chart here, you can see the gray areas, the CFTC positioning from speculators, and the red line is Euro USD. Euro USD, if it were to catch up with the COT position, should be trading about 300-400 pips or 3 to 4 handles higher from where it is today. One of the reasons why it's trading lower is because the Ukraine and Russia crisis right now that is weighing on Euro USD. Plus, market is really waiting for the March ECB meeting to see what the bond market, what they're going to do with the QE and the repurchase program. So it's got time to catch up to that. But that looks like that's the direction euro is headed currently, unless something new happens. And GBP USD really, or GBP on its own, is kind of sort of flat, as it's not really doing much. Now, as we are headed in the next 2 weeks to a central bank meeting for the RBA, it's worth having a look at the interbank cash rate futures implied yield curve. Basically what this is saying is the dotted blue line is the current rate for the RBA. The bars, if they're underneath it, market is expecting or pricing for a cut. If it's above it, market is pricing for a rate hike. And it's very unusual to see RBA cutting rates. So, and by March and April, market is actually pricing for a rate cut, which is really unusual. And in my opinion, that can support AUD going into the next 2 weeks. Specifically on Wednesday, we will have wage inflation data for the Australian economy, and that will be very keenly watched by economists and market participants, because that could push RBA to change their neutral stance to a bit more hawkish in 2 weeks' time. So on Wednesday, we're going to see a spark of volatility, and then Wednesday onwards, going to Thursday and Friday, we start pricing in what we think the RBA will be doing. Either will be bullish or bearish. Today, I am leaning bullish on AUD. That can dramatically change based on whatever that data will be on Wednesday, about 2 or 3 o'clock in London time in the morning, and then different time frames, depends where you are in the world. So that's it. That's the 1-2 things that we wanted to discuss. Euro positioning, what we expect from AED. There could be some good movements, and also that the yen pairs will likely struggle as long as inflation expectation is kind of sitting at these levels. We even have the inflation break even for. So we have the inflation break even. We also have the forward inflation expectation rate. It's this one here that I mostly showed in the previous videos, and you can see more or less that's kind of telling you the same story. It's just going to show you different figures as that's based on the 5-year, the other one based on the 10-year, but they are all on the same curve. I would even argue that the 5-year one is probably a little bit more closely correlated with the FX pairs. But have a look at the individuals for next week. Let's go through some charts real quick. Let me remove this inflation expectation chart. Let's drill down to ADJPYs. That's one of the pairs which I believe got some movement in it next week. Take the correlation away. We're down a candle chart. We're looking at the monthly now, which is since the start of this year, we're pretty much caught in this whole range. There's 2 reasons for that. One, inflation expectation is coming down, so market is thinking, well, yen pairs should be coming down. On the other hand, you have that the Bank of Japan is incredibly dovish, and all the other central banks are incredibly hawkish, or at least neutral, and that will usually mean that we should see an upside movement. But macro data isn't quite there yet. That's why we're going to see this push and pull until a bigger breakout comes. It would be easier to forecast where this breakout will be once we know where the growth is going and exactly how the other central banks will be reacting. Right now, there's reason to believe it could go up, but then again, the inflation expectation is really capping bigger gains down the line. So there's not a lot to really expect from the yen pairs, and more or less you're going to see the same from all the other yen pairs. They're kind of stuck from the monthly perspective. So trend trading maybe not setting up just yet. But drilling down to the daily, and specifically because we had the more recently inflation expectation dropping off, I really would like to see if risk off picks up again, specifically with Ukraine and Russia. I really like to see these lower wicks here all get taken away, and on CAD-JPY we see 89.50 drop away and explore lower levels if that all materializes. It's a bit more if and when with a lot of these trades right now. Another thing to look at is Euro USD on the 3rd of February. We had a big pivot from the ECB. That level has not been breached yet, but there's a huge issue again with Russia and Ukraine is throwing spanner in the works, and it's a bit unpredictable how this will pan out. If there is going to be a war, then Euro-USD will very quickly lose all these levels and will be easily trading 2 or 3 handles lower. But based on what we see on the CFTC data, and if a war is averted, you could expect this to move up further up here. From a timing perspective, I'm looking toward mid to late March for this to resolve either way. And that's the sort of thing we're looking at. Another pair I'm looking at and I'm interested specifically post Wednesday is GBP AUD. More or less, GBP, we kind of know what the hawkishness from the Bank of England is. They kind of came out and said what they want to do. They really made it clear that the amount of times they're going to raise rates is going to be limited. So it's going to be a very short hiking cycle. They already said that. So kind of the bullishness in pound will be more down to what happens to the other currencies. And that takes me to AUD on the other side, GBP AUD. So for GBP AUD on Wednesday, we're going to have a data point which will be critical for us to price in RBA meeting in 2 weeks time. So from there on, I really like to see a breakdown lower. If I were to show you the yield spread between UK and Australia, you can see it's moving in favor for Australia. So if I were to compare this with GBP AUD, and you may or may not know the yield spreads tend to lead the way for GBP for Forex pairs, and in this scenario I would like to think that the yield spread is leading the way again, and that should mean for GBP AUD to resolve lower 3 or 4 handles in the coming month. That's all I wanted to cover. Really, the rest is going to be up to really what data comes out, and we have a bit of a wait and see what happens with Russia and Ukraine. My base case is there won't be any war. It would be a little bit unusual to go from war for just for such a, how to put it, for a reason which can be resolved on a political level. But if it's not resolved, obviously we need to be prepared to see where we can protect our own gains as well. And in 2 weeks time again we have the NFP, which will be crucial for Euro-USD and all the USD pairs, so keep an eye on that. And apart from that, it will be just really gauging what the risk sentiment is on a daily basis. So check your yen pairs, check yields, and check indices to see where the risk sentiment is lying. Talking of which, it's worth having a look at the WIX, which is the CBOE volatility index. That gives you sometimes a gauge to how bad things could go. So if you look at this on a daily, if you see these huge spikes in the VIX, that's usually time to fade and you can expect risk on to continue. Right now we're trading quite elevated and we had a couple of spikes. If the risk doesn't sour any further, you can start expecting to see 20 level again, but I think it's a bit too early to start aggressively buying dips on the indices. There might be another jump up. Again, it's ideally to wait for this huge wicks to emerge, to start to see the exhaustion in the market, if that makes sense. But that's all I wanted to cover. I wish you a very successful 2 weeks, and I'll be seeing you again in about mid-March. I wish you all the best. Bye for now.